Now let's talk about the mistakes investors make with PE ratio, because this is where people get hurt. Mistake one, buying a stock purely because it has a low PE. A low PE can mean a stock is cheap. It can also mean the business is struggling, the industry is declining, or earnings are about to fall. Always ask why the PE is low before assuming it's a bargain. Mistake two, avoiding stocks with high PE ratios. Some of the greatest wealth creating stocks in history had PE ratios above 50 or even 100 when they were at their best buying points. Infosys, TCS, Asian Paints all had high PE ratios for extended periods while delivering exceptional returns. A high PE is only a problem if the growth doesn't materialize. Mistake three, using PE ratio in isolation. The PE ratio is one tool in a toolkit, not the whole toolkit. Always combine it with other measures like revenue growth, debt levels, return on equity, and sector performance. No single number tells the whole story. So to summarize, the PE ratio tells you how much investors are paying for every rupee of company profit. Calculate it by dividing share price by earnings per share. A high PE suggests growth expectations. A low PE suggests either value or risk. Always compare within the same sector and against historical averages, and never use it in isolation. In Thursday's video, we're going to put this concept to work, comparing TCS and Infosys using PE ratio and other key metrics to figure out which stock looks more attractive in 2026. Make sure you're subscribed so you don't miss it. Drop a comment below. What stock do you want us to analyze using PE ratio? I read every single one. This is educational content only. Do your own research before making any investment decisions. See you Tuesday. Now, hotshot, how do you calculate the PE ratio yourself? The formula is straightforward. PE ratio equals share price divided by earnings per share. Earnings per share, also called EPS, is the company's total profit divided by the number of shares outstanding. You don't need to calculate this manually. Every stock on Screener.in, Money Control, and NSE India shows the PE ratio and EPS directly on the stock page. But understanding the calculation means you understand what the number actually represents. And that's what matters. What does a high PE ratio mean versus a low PE ratio? This is where most beginners get confused. A high PE ratio, say 50, 60, or 80, means investors are paying a lot for each rupee of earnings. This usually happens when investors expect the company to grow rapidly in the future. They're not just paying for today's profits, they're paying for tomorrow's potential. Technology companies and fast-growing businesses typically have high PE ratios. A low PE ratio, say 8, 10, or 12, means the stock is cheap relative to its earnings. This could mean the company is undervalued and a bargain. Or it could mean the market expects the company's earnings to fall. Low PE is not automatically good. High PE is not automatically bad. Context is everything. How do you use PE ratio to compare companies? The most powerful way to use PE ratio is comparison, but only within the same sector. Comparing the PE of a bank with the PE of an IT company is meaningless. Different industries have different normal PE ranges. Banks typically trade at PE ratios of 10 to 20. IT companies often trade at 20 to 35. Consumer goods companies sometimes trade at 40 to 60. What you want to do is compare a company's PE ratio to its sector peers and to its own historical average. If HDFC Bank is trading at a PE of 18 and its 5-year average PE is 25, it might be undervalued. If it's trading at 35 against a historical average of 25, it might be overpriced. Screener.in shows you both current and historical PE for any Indian listed company. There is one number that professional investors look at before buying almost any stock. It takes 5 seconds to check. Most beginners have heard of it, but very few actually understand what it means. That number is the PE ratio. And by the end of this video, you will know exactly how to use it to evaluate any stock in the Indian market. Welcome back to Market Mindset, where we break down the stock market clearly, honestly, and without the noise. We post every Tuesday, Thursday, and Saturday. Today, we're covering one of the most fundamental concepts in investing, the price to earnings ratio. Understanding this single concept will change how you look at every stock price you see from this point forward. So, what exactly is the PE ratio? PE stands for price to earnings. It tells you one simple thing: how much money investors are willing to pay for every rupee of profit a company earns. Let me give you a concrete example. Imagine a company earns 10 rupees of profit per share. Its stock is currently trading at 200 rupees per share. The PE ratio is 200 divided by 10, which equals 20. This means investors are paying 20 rupees for every 1 rupee of profit the company earns. That's it. That's all the PE ratio is. A simple measure of how expensive or cheap a stock is relative to its earnings.